In the world of market speculation, there are two distinct paths to mastery. The first is the path of the long-term position investor, a strategist who analyzes macroeconomic tides and the fundamental value of a business over a horizon of months and years. The second is the path of the short-term trader, an operator who lives in the immediate present, whose success is measured in days and sometimes even hours. This second path is a world of intense focus, rapid decision-making, and a deep intuitive understanding of the market's daily rhythms. Few have navigated this world with more skill, discipline, and longevity than Linda Bradford Raschke. For over 4 decades, she has thrived as a professional speculator, a trader's trader, who has built her career not on grand predictions, but on the systematic exploitation of short-term, repeatable patterns. We will explore how Raschke's early career on the chaotic trading floors forged her unique perspective, and how she later translated that intuitive feel into a structured, logical process. The centerpiece of this analysis will be her interpretation and application of a classic but often misunderstood methodology, the Taylor trading technique. It is a powerful framework for understanding the market's hidden 3-day cycle, a rhythmic pattern of manipulation and emotion that, once understood, can provide a significant edge for the short-term operator. This is the story of how to find the rhythm in the noise. Her journey began not in front of a computer screen, but in the physical, visceral world of the exchange floor in the early 1980s. She started her career on the Pacific Coast Stock Exchange, and later became a market maker in options on the Philadelphia Stock Exchange. This was a critical and formative experience that is almost impossible to replicate today. As a floor trader, she was not a passive observer of prices on a screen. She was an active participant inside the very engine of price discovery. She learned to read the market through the flow of orders, the tone of the brokers' voices, the size of the bids and asks, and the palpable waves of fear and greed that would wash over the trading pit. This environment taught her to think of the market not as a series of abstract data points, but as a living, breathing entity with its own distinct personality, and most importantly, its own recurring rhythms and habits. After years as a successful floor trader, she made the difficult transition to trading off the floor from a screen. She now faced a new challenge: how to replicate the intuitive feel she had developed in the pit using only the limited information of a price chart. This challenge sent her on a quest to find a systematic framework that could codify the short-term, cyclical patterns she had learned to recognize. She became a voracious student of the classic market operators and their methods, and it was during this search that she discovered the work of a little-known trader from the mid-20th century, George Douglas Taylor, and his book, The Taylor Trading Technique. For Raschke, Taylor's work was a revelation. It provided a logical, structured explanation for the 3-day rhythm she had already observed in her years on the floor. It was the intellectual blueprint she needed to build a robust, systematic approach to her short-term trading. To master Linda Raschke's application of the technique, we must first deconstruct the foundational philosophy of its creator, George Douglas Taylor. Taylor was a market cynic and a realist. His entire method is built upon a single, powerful, and somewhat conspiratorial premise: that the market is not a random walk. He did not believe that prices moved based on the collective, independent decisions of thousands of rational actors. Instead, he viewed the market as a game that was actively and continuously manipulated by a group of large, informed professional operators, whom he called the smart money. According to Taylor, the primary objective of this smart money is simple: to accumulate positions at low prices from the uninformed public, and then to distribute those same positions back to the public at high prices. To achieve this, they cannot simply buy and sell whenever they want. They must actively create the necessary emotional conditions: fear to induce selling at the lows, and greed to induce buying at the highs, to facilitate their operations. Taylor's great insight was his belief that this process of manipulation was not random. It occurred in a repeating, predictable, and surprisingly consistent 3-day rhythm. This 3-day cycle was, in his words, the book that the smart money used to run the market day in and day out. For Taylor, the key to success was not to predict the news or to analyze fundamentals, but simply to learn how to read this 3-day book and to trade in harmony with the intentions of the smart money, not against them. This 3-day cycle is the absolute core of the Taylor trading technique. It is a recurring pattern of market behavior, a short-term rhythm of accumulation and distribution. Let's deconstruct the anatomy of this cycle day by day to understand its internal logic and the psychology it is designed to exploit. The first day of the cycle is the buy day. This is the day that the smart money wishes to accumulate a long position. To do this effectively, they need to buy from panicked or discouraged sellers. Therefore, the primary objective of the buy day is to create a state of fear and pessimism. The typical price action of a buy day is a drive downward early in the session. The market will often open and then push deliberately below the low of the previous day. This action is a brilliant piece of psychological manipulation. The break of the previous day's low triggers the stop-loss orders of weak, long positions. It also encourages breakout sellers and bearish traders to enter the market, convinced that a new downtrend is beginning. It creates a cascade of selling from the weak hands. This is precisely what the smart money wants. As the public is selling in a state of fear, the smart money is on the other side of those trades, patiently absorbing the supply and building their long position at bargain prices. The classic signature of a successful buy day is this drive down to a distinct low point, followed by a rally into the close as the selling pressure is exhausted and the smart money's buying begins to lift the market. The objective for a trader following the Taylor technique is to identify this engineered drive to a low and, acting against all natural emotional instincts, to buy into that weakness, anticipating the subsequent rally on the next day's cycle. The second day of the cycle is the sell day. This is the day that the smart money, having accumulated their long position on the buy day, wishes to distribute it at a higher price. To do this, they need to sell to eager optimistic buyers. The primary objective of the sell day is therefore to create a state of greed and euphoria. The typical price action of a sell day is a rally upward, often starting right from the open. The market will push decisively above the high of the previous day's buy day. This action, like the breakdown on the buy day, is a form of psychological manipulation. The break of the previous day's high triggers the buy-stop orders of breakout traders. It creates a fear of missing out, or FOMO, among the public, who now see the market rallying strongly and are desperate to get in on the action. This is precisely what the smart money wants. As the public is stampeding in to buy in a state of greed, the smart money is on the other side of those trades, methodically selling the position they accumulated yesterday at a significant profit. The classic signature of a sell day is this strong rally to a distinct high point, which is often made early in the session, with the market frequently weakening into the close as the institutional selling overwhelms the public buying. The objective for the Taylor trader is to sell their long position, which they entered on the buy day, into this wave of artificially created strength and greed. The third and final day of the cycle is the sell short day. This is the most nuanced day of the rhythm. On this day, the smart money, having profited from their long trade, now wishes to initiate a new short position, betting on a price decline. To do this, they must first create a bull trap to find sellers at a high price. The primary objective of the sell short day is to create one final burst of false optimism before reversing the market. The typical price action of a sell short day is a rally in the morning that attempts, but ultimately fails, to exceed the high of the previous sell day. This morning rally is designed to lure in the last of the hopeful, buy the dip public participants. When this rally runs out of steam and reverses, it is a powerful signal that the buying pressure is completely exhausted and the sellers are now in control. This failure at the old high is the key event of the day. As the market rolls over and begins to decline, the smart money is initiating their short positions. The objective for the Taylor trader is to wait for the failure of that morning rally, and then to sell short into that first sign of weakness, anticipating the decline that will likely follow on the next day, which, in a perfect cycle will be a new buy day, starting the rhythm all over again. This 3-day rhythm, a move down to a low to facilitate buying, a move up to a high to facilitate selling, and a failed rally to facilitate shorting, is the simple, elegant, and powerful model that George Douglas Taylor proposed as the fundamental building block of short-term market action. The Taylor trading technique, developed nearly a century ago, suggests a highly structured, almost predictable 3-day rhythm to the market. Do you believe such simple cyclical patterns can still be effective in today's complex 24/7 high-speed markets, or have they been completely arbitraged away by algorithms? Share your view in the comments. This framework, a map of the market's short-term psychological currents, was the tool that Linda Raschke recognized as the perfect codification of her own hard-won experience as a floor trader. But a map is not a complete trading system. A map shows you the terrain, but it does not tell you exactly where to place your feet, how to navigate obstacles, or what to do when you encounter a detour. It is a theory. The genius of Linda Raschke was her ability to take this abstract, conceptual map from Taylor and forge it into a concrete, testable, and robust trading methodology, complete with her own set of filters, confirmation tools, and, most importantly, a non-negotiable system of risk management. That is the subject of our next discussion, the practical application and the specific rules of the Raschke method. This process of deconstructing a classic market theory to find its modern application is central to professional development. To continue this journey and master the habits of systematic thinking, we invite you to subscribe to this channel and click the notification bell. Join our community of serious market participants. We will now move from Taylor's ideas to Raschke's application. This is a masterclass in professional execution, a deep dive into how a master craftsman takes a classic concept and elevates it into a durable, long-term edge. We will explore the specific overlays she adds to the raw Taylor cycle to increase her probability of success. We will deconstruct her specific numerical rules for entry, stops, and profit targets. And we will conclude with her unique philosophy of trading as a high-stakes performance art. This is the operational blueprint of a master swing trader. The first and most critical layer that Linda Raschke adds to the Taylor trading technique is the principle of context. She understands that the 3-day cycle does not operate in a vacuum. It is a short-term ripple on the surface of a much larger ocean, and the direction of the ocean's tide, the primary market trend, is of paramount importance. A novice trader might try to apply the Taylor cycle mechanically to any market at any time, but Raschke, as a seasoned professional, knows that the probability of a setup succeeding is dramatically influenced by the broader market environment. Her first and most important filter, therefore, is an analysis of the primary trend. She often defines this primary trend using a simple, long-term moving average, such as the 20-week or 30-week exponential moving average on a weekly chart. This provides a clear, objective measure of the market's long-term health. The application of this filter is simple but powerful. In a confirmed primary bull market, when the price is consistently trading above this long-term moving average, she will give significantly more weight and capital to the bullish setups within the Taylor cycle. She will aggressively look for buy-day opportunities, viewing pullbacks as low-risk entry points to join the prevailing uptrend. Conversely, she will treat the sell-short day setups with extreme caution. She may ignore them completely or trade them with a much smaller position size, knowing that she would be fighting against the market's primary upward momentum. In a confirmed primary bear market, the opposite logic applies. When the price is trading below the long-term moving average, her primary focus shifts to the bearish setups. She will be patiently waiting for the sell-short day patterns to emerge, viewing the failed morning rallies as high-probability opportunities to join the dominant downtrend. The buy-day setups in this context are viewed with skepticism, as they are likely to be just temporary bounces in a larger decline. This simple top-down filter of aligning the short-term cyclical trades with the long-term primary trend is a fundamental principle of her approach. It is a way of ensuring that she is always swimming with the tide, not against it. a practice that dramatically increases the odds of success. The second layer of her methodology involves the use of momentum oscillators for confirmation. While the Taylor cycle provides a timing framework based on a 3-day rhythm, Raschke adds a layer of quantitative confirmation by using indicators like the stochastic oscillator or the relative strength index, RSI. These tools measure the speed and intensity of price movements, allowing her to gauge whether a market is in an overbought or oversold condition. This is not about using these indicators as standalone buy or sell signals. It is about using them to confirm the psychological state that the Taylor cycle is supposed to be creating. For example, on a classic buy day, the theory states that the smart money is engineering a move down to create fear and panic. Raschke will look for her momentum oscillator to confirm this state of emotional exhaustion. As the price drives down to make its low, she wants to see her oscillator in a deeply oversold condition. This provides a secondary objective piece of evidence that the selling pressure is reaching a climax and that the market is ripe for a reversal. A buy-day low that is confirmed by an oversold oscillator reading is a much higher probability setup than one that occurs while momentum is still neutral. Conversely, on a classic sell day, the theory states that the smart money is engineering a rally to create greed and euphoria. Raschke will look for her momentum oscillator to confirm this state of excess optimism. As the price rallies to make its high, she wants to see her oscillator in a deeply overbought condition. This confirms that the buying enthusiasm is reaching an unsustainable peak and that the market is vulnerable to a pullback. By demanding this confluence of evidence, the cyclical timing of the Taylor day, and the quantitative confirmation from a momentum indicator, she filters out weaker, less reliable setups and focuses her capital only on the highest probability opportunities. The final layer of her analytical framework is the use of classic support and resistance, what she calls identifying the point of reference. A point of reference is a significant prior price level on the chart where a previous trend has reversed. These are the historical battlegrounds between buyers and sellers, the swing highs and swing lows that define the market structure. Raschke uses these levels to add a third layer of conviction to a trade setup. For example, if a buy-day low in the Taylor cycle happens to coincide precisely with a major prior support level on the daily or weekly chart, the probability of a successful bounce from that level is dramatically increased. She is now combining 3 distinct factors: the cyclical timing of the Taylor method, the oversold confirmation from a momentum oscillator, and the structural support from a key price level. This 3-dimensional approach is what elevates her trading from a simple pattern-based method to a robust, professional-grade methodology. With this multi-layered analytical framework in place, we can now deconstruct the practical rules of engagement that Linda Raschke uses to execute her trades. This is the systematic, almost numerical process that translates her analysis into action. The first rule is a disciplined entry tactic. Raschke rarely tries to be a hero and buy the absolute low of a buy day or short the absolute high of a sell short day. She understands that this is a low probability endeavor. Instead, she waits for a small piece of confirmation that the tide has begun to turn. On a buy day, after the price has made a new low and she has observed the oversold condition on her oscillator, she will wait for the price to start to rally off that low. She might use a tick test, waiting for the price to trade a certain number of minimum price fluctuations, or ticks, above the low before entering. This small confirmation proves that buyers have indeed stepped in to defend the level and that the immediate selling pressure has abated. This tactic means she may miss the absolute best entry price by a small margin, but it significantly increases her probability of being in a successful trade. The second and most important rule is the non-negotiable stop loss. This is the bedrock of her risk management and the key to her longevity in the business. A stop-loss order is placed immediately after a position is entered. There are no exceptions. The placement of the stop is logical and predefined. For a long position entered on a buy day, the stop-loss is placed just below the low of that day. For a short position entered on a sell short day, The stop loss is placed just above the high of that day's failed rally. This ensures that her risk on every single trade is known, defined, and most importantly, limited before the trade even begins. This is the ultimate act of discipline and humility, an admission that any trade can be a losing trade, and that the primary job of the trader is to ensure that those losses are always small and survivable. The third component is the profit target, her strategy for exiting a winning trade. Her exit strategy is just as systematic as her entry strategy. The Taylor method itself provides a simple, time-based exit. One should look to sell the long position entered on the buy day during the rally of the following sell day. Raschke uses this as her primary guide, but she refines it with other tools. She will often use her points of reference, the prior swing highs and lows, to set logical price targets. If a strong prior resistance level lies just ahead, she may take her profits as the market approaches that level, rather than waiting for the end of the day. She also watches her momentum oscillators for exit signals. If the market rallies on the sell day and her oscillator moves into an extreme overbought condition and then begins to turn down, she may take that as a signal to exit immediately, even if a higher price target has not yet been reached. This flexible but rules-based approach to profit-taking allows her to adapt to the market's real-time behavior, capturing the heart of the move while avoiding the trap of greed. Finally, we must touch upon her overarching philosophy, the mindset that makes the execution of this rigorous system possible. Linda Raschke often speaks of trading as a performance art. This is a profound and powerful metaphor. Like a concert musician or a professional athlete, she views the act of trading as a performance. The outcome of any single performance or trade is not entirely within her control. There is always an element of luck and randomness in the markets. What is within her control, however, is the quality of her preparation and the flawlessness of her execution. Her daily routine is like that of a professional athlete. It involves pre-market preparation, mental rehearsal, and a deep study of her playbook of setups. When the market opens, her job is to execute her plan with the same focused, unemotional precision as a surgeon. After the market closes, she conducts a post-game review, analyzing her performance, not just her profits and losses. Did she follow her rules? Did she execute her plan without hesitation? Did she manage her risk according to her system? For Raschke, the long-term profits are a byproduct of a relentless focus on a perfect process. What we have just outlined is not a simple signal. It is an entire diagnostic process. It is the intellectual framework that a master trader uses to navigate the markets with clarity. Developing this kind of structured thinking is the most critical task for any serious market participant. To continue this journey and reinforce these professional-grade analytical habits, we invite you to subscribe to this channel and click the notification bell. In conclusion, the legacy of Linda Bradford Raschke is that of a living bridge between the classic intuitive floor traders of the past and the systematic rules-based traders of the present. She has demonstrated that a simple, logical concept like a 3-day market rhythm, when elevated with layers of objective confirmation tools and executed with an iron-clad, non-negotiable risk management discipline, remains a powerful and effective methodology even in the complex high-speed markets of the 21st century. Her career is a testament to the power of observation, adaptation, and above all, the profound wisdom of treating trading not as a get-rich-quick scheme, but as a professional craft that demands a lifetime of dedicated practice and flawless performance. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.